Okay, we're gonna get started now, and really quick table of contents. This is a high-level analysis that's only gonna go over the quantitative stuff, not really too much of the qualitative, and we're gonna be digging into Shopify's business, and I'm gonna do a really quick overview. I'm gonna dig into historicals, build out a high-level DCF, discuss the price based off what the DCF tells us, and then I'll leave some time for Q&A. And let's get started with the overview. So before I go into this, Shopify is going to report earnings tomorrow before the stock market opens. And I'm really interested in the stock because I used to own a clothing brand, and we built on Shopify, and I operated it for 2 years, and it was just such a sticky platform that I just could not imagine using any other platform for e-commerce, and I'm sure a lot of entrepreneurs feel that way too. So I think the overall business is amazing. It's just that it probably was very overpriced with this run, and now that it's dropped like almost half pretty much, like I'm really curious to see on a DCF perspective what is Shopify worth. So that's the whole purpose of all this, and I just want to go over a few slides with all of you. This is from Shopify's own investor presentation, and as you can see, I think when most people think of Shopify, they think like, oh, you just build a website on there, but there actually are so many other services that are really important. So for our clothing business, for example, we shipped through Shopify, and so we would pay Shopify a small amount every time we printed a shipping label, and they provided a big discount for Shopify shipping, so there was no reason for us not to use it. They also have things like Shopify Capital, which I'm not sure if this is the working capital thing, but they made it so that they offer any entrepreneur or business owner, hey, if you want to basically borrow money from us and pay through the future sales that you have, that's also something that they do, and you pay like a small interest rate amount, etc., etc. They have pretty much the best solution to really quickly build any e-commerce store. And these are different rates: $29 a month, $79 a month, $299 a month, $2,000. But there's also this take rate, which is really important. So if you're on the more basic plan versus Shopify or advanced, you pay a small percentage for every order to Shopify. So you pay like 3% plus 30 cents for every order on Shopify if you own the store. So that's basically how they make money. There's two ways they segment their revenue, but it's basically that take rate that I just showed you guys, and then like all their other stuff. All right, and as you can see, they really have been expanding their business into a lot of different areas. They used to just be pretty much only focused on Shopify, and now they're just trying to be everywhere. And I don't know if there's much else here that's important. So yeah, I think we can just jump into it. And by the way, I won't be answering questions during the stream mostly. I might pause maybe here and there, but it's just really distracting. So all right, let's now dig into historicals. So let's get started, I guess. And I'll also talk as I go through everything, and I'm gonna basically just rip off what we had from our Facebook valuation exercise and just use this as a template. This is what I would do at JPM pretty often too, is just get something that's already been built and then try to use it to save some time, basically. All right, so then we'll call this optimistic case. And all these numbers are going to change, but let's just leave them there for now. Okay, so the first thing I want to do is go through the income statement and look for some key trends, and then we'll be able to project out our data. I think so from our historicals here, we only have it since 2013. So I'm going to delete these columns. By the way, as I'm going through this, I kind of briefly looked at what Shopify is being valued at right now versus revenue and things like that. I'm fairly certain that we're going to need some really, really aggressive projections for Shopify to be worth what it's currently trading at right now. I highly doubt that Shopify on like a fundamental basis should be trading at what it's trading at right now. Okay, so all right, so these are the projections for Shopify, and let's see how far they go out. Actually, let's go to FactSet. As this is loading, I see that there's someone, or Dark Shinigami, asked a good question because the channel, I did make a video talking about how it's crypto only, and then I got a lot of feedback saying that people wanted me to keep doing stock stuff. I was gonna just do stock stuff in my new careers related channel, which is down in my description, which will only focus on career stuff. And I was gonna do DCFs and trading comp stuff there, but then it just made more sense to have like an investing channel, which Rare Liquid will be, and then Rare Liquid Careers will cover all the career related videos. All right, so right now on Shopify, what I'm doing is I'm trying to see how reliable the projections are for the street. And so as you can see here, after 2024, a lot of analysts don't actually project out that far. This is for revenue. So then that means that these figures are not very reliable. Just something good to know. And right now we got to our revenue, and so I think what's important to note first here is that 2020 was an absolutely insane year for Shopify. I guess, these numbers are pretty high in terms of revenue growth as well, but when you have a larger base, it's harder to grow faster. And Shopify actually accelerated its revenue growth, which is obviously a great sign. And this was largely due to COVID-19 and e-commerce just booming so much. And so right now in the next year, the street is estimating that Shopify will grow by 56%, which is also super impressive. And I'd say that these numbers are pretty much, we can just ignore, because you can see that analysts are projecting based on these numbers here that Shopify will grow by 54% in 2024. But again, these numbers are not really reliable. So all of this pretty much don't really need to focus on. I'd say this 2021 number is actually 90 to 95% going to be correct or so. It will be like plus or minus a few percentage points because there's only one quarter left in 2021 that Shopify hasn't reported. And so an analyst gets some guidance from management as to how much Shopify will be growing. So we can be fairly certain Shopify will grow above 50% in 2021. And then the drop off to 33, acceleration to 35. This is a little odd too. So we'll adjust those numbers a little later in our actual projections. And for cost of goods sold, let's go to our income statement. Total cost of revenue. Okay, so since I guess I'll need to careful of my posture. Okay. All right. By the way, I'm doing this today because Shopify is reporting earnings tomorrow, and honestly, I just want to know if I should buy the stock or not. I do own one share of Shopify, and it's a stock that I really want to own more of, but I don't want to buy much. I don't want to buy more if it's way too overvalued with this current economic environment, which actually it probably is going to be, but we'll see. Okay, sales and marketing's here. So now let's dig through the income statement. We have sales and marketing, and then research and development, general administrative expenses, pretty standard stuff. And I'm gonna move this here. So marketing and sales here. R&D, G&A, total operating expenses, percentage of sales. All right. Getting to our EBIT, which is a pretty important figure, and I can provide some thoughts on it once I calculate it. EBIT stands for earnings before interest and taxes, by the way. All right. Sorry, I'm just looking at some questions. So Saad Wali Alami brings up some good points, I guess, but I feel like you might have joined after I went through the qualitative stuff a little bit. Because I used Shopify for many years as a small business owner. Because before I was working on, okay, I'm not gonna go through it again. Whatever, you can think whatever you want, actually. Okay, so let's see. Let's go to EBIT. Operating income. So I'm guessing 2024 again is not going to be very, not reliable. Okay. But interesting. So you can see that for many, many years, EBIT was not, operating income was earnings before interest and taxes. Operating income was not, was negative for Shopify, and only recently has the company become pretty profitable, pretty rapidly over the past few years. And the street is projecting that it'll jump to 32% over from 2020 to 2021, which is a pretty sizable jump. And again, analysts are usually pretty correct about the next year, so I don't think this 32% is going to be wrong, or I don't think it's too high. Before I go into it, before I move on though, let me just double check my numbers. Okay. So right now we're going into the income statement. I want to just make sure that the numbers I calculated are correct. Okay, so operating income for 2020 should be 90.1. 2020. That's super off. What is this? Oh, December 2020. Okay, 71, so that's super off. Let's see what's wrong. So gross profit is 1,568 versus 1.541. That's super weird. Okay, I'm guessing. Okay, that's one thing. So this now matches. The gross profit matches. Beforehand, I was connecting to something that a cost of goods sold that had adjustments. Sales and marketing 602, research and development 552. Marketing should be 602. Oh, okay. So I'm connecting to something that has adjustments, and that's not what they do with their income statements. So I need to relink these. G&A. Okay, now operating expenses 1.4. Is that closer? Yeah, Yeah, 1.451367. 1.451. Which is still off a little bit. What's going on? Okay, let's see. 602, 552, 602, 552, 245. And then gross profit 1541. Okay, so that's all right. Then there's transaction and losses. Maybe I do need to incorporate that, I guess. Sorry I'm so quiet, guys. I'm just concentrating. Right now I'm adding a formula that if it's an error, I'm going to make it 0. Oh, that's weird. Oh. Wait. Oh wait, it's not gonna be, it's actually not an error. So, okay, I'm gonna just make these 0. Oh. Man, this is a mess right now. Sorry, guys. Okay, there we go. All right, so then total operating expenses 1451. That matches. And then EBIT should be 90. That matches. 90,153. Yep, perfect. All right, so then, okay, this is pretty crazy then. EBIT is actually at 3% this year, and then the street is estimating that it's going to go to 32% in 2021. Which we can, you know, it's a big jump. Let's see how accurate it is, because we can look into the quarterly figures here, and there's only one quarter left, right? So we can see for 2021 what is Shopify's operating income margin. So operating income is here. Okay. Okay, so in 2021 so far, in the past few quarters, Shopify has gotten to 587 million in operating income and 3 billion in sales. And that's around 18% right now in terms of their EBIT margin. Let's look at their latest quarter too. So 18% is a lot higher than 3%, but still not that high. Very weird, I'd say. It could be possible that the street is making certain adjustments, but let's not worry about it too much for right now. What's important is, okay, so actually no, this is very important. This is gonna bother me. Let's see what the street thought earlier. Okay, so the street is looking at things a little bit differently than I am. So let's see, income loss from operations, 90 million in year 2020. Well, I guess, I'm not sure what this could be. Okay. So when we look at gap figures, they're a lot smaller. So something like 257. Oh wait, sorry. Wow, I'm so stupid. It wasn't even looking at it wasn't even using the right formula. Okay, so this makes more sense because if we look at our income statement here, total operating income is 254 million right now, and on a gap basis, there are people at streets projecting 275, so that does make sense, or that's like it follows a more linear path, I guess. But oh man, I wish I could get into these reports and see what they're adjusting for. because this is a pretty big jump. I'm gonna have to see what they adjust for. Okay, so they talk about adjusted operating income was 140.2 million compared with adjusted operating income previous. Do I need to figure out what they're adjusting for. Okay, so adjusted gross profit, adjusted operating income, blah, 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 excludes the effect of stock-based compensation, expenses, and related payroll taxes, amortization of acquired intangibles, and a real estate-related impairment charge. Adjusted net income, blah, blah, blah. Okay. So now we just have to think about if we should use their adjusted operating income for the DCF, or if we can rely on it. If we don't, I'm gonna do that later after I finish off the rest of these historicals. So once we actually start projecting, I'll actually look into that stuff. Okay, so interest, where are you? Sorry if this is a boring stream, guys. I'm just reading and thinking. Why can't I find this? Income loss from continuing operations, provisions, benefit for income taxes. Okay, non-operating income and expense. I'm assuming that's what it is. Okay, they got a bunch of stuff here. I mean, interest is not really going to even be important for us. So what I'm going to do is we're going to back calculate into that. Instead, find our earnings before taxes. Income from continuing operations before income taxes. So it's probably this. Let's double check. Income before income taxes should be 240. So it's this line here. Okay. Is that right? Nope. $90 minus -150 is 240, so that should be right. And then percent of EBIT. Taxes. $319. All right. So, oh, I need to do taxes too. All right. This looks correct. So, I mean, in general, with all this work that's just been done, I think what it's just really telling me is that Shopify it's just starting to get profitable. So the issue with the discounted cash flow, which what we're going to build now, is that it's going to be just super hard to predict its cash flow. So, I mean, well, I personally think that this will just provide a rough sense of like what do you need to believe for Shopify to be worth a certain share price or something like that. But it's going to be hard to really rely on all the figures that are on this valuation analysis, but we'll see. Okay, so DNA is here. Oops. All right. CapEx. Acquisitions of property and equipment. Okay. So because Shopify is it's like a platform business, so it's like internet, or it's like oops. It doesn't have that many assets it needs to buy because everything is just kind of like on the web. So DNA and CapEx are not really a big deal, is what this is telling me. Okay, so we have our cash flow items here now, and so now it's time for the DCF. Let's actually pull in the formulas, save some time. This is the Facebook DCF I built a few days ago. I'm just going to copy the formulas. So a good, helpful trick for you guys trying to learn Excel, Alt ESF. Paste just the formulas. I guess they're in different rows. Yeah, so this should be 27. $51. All right, so this is working. Okay, now this is all, whoa, what is all this stuff? Yeah, all this is going to be pretty messy until I fix it. All right, before going on to the DCF, I'm going to pause and answer some questions because I want to make sure that we're all on the same page. Okay, so will I include full 2021 free cash flow in your model, or you only consider Q4 2021? It's a good question. I should probably only include Q4 2021. And do you know what all the teams you're using when you learned to build a DCF? I'm not really sure what that question means. Do you think it's faster to just use keyboard than using mouse? Yep, definitely faster. And DCF is intrinsic value. Yep. So interning at an elite boutique this summer as an MBA associate, do you have any advice? Sorry, I can't answer that right now, but I will leave time in the Q&A for any kind of questions in the future. Okay, so now we got to project out our revenue. And so 2021 should be reliable, right? Hold up, actually. Just gonna delete all this stuff. All right, this is where everything gets really tricky. So, street case is what we're gonna first start off with for the years that we can actually believe. So right now the street thinks that 2021 will grow by 56%, which we believe, drops down to 33% in the following year, which I feel like is a relatively borderline conservative assumption that I personally can see happening. And then the uptick to 35%, I don't really believe. I think that just has to do with the analysts projecting things, kind of like some projecting and some dropping off and things like that. So I don't really believe that, so I'm not going to take that into consideration. And I think from here, 2023 to 2030, we can just do what we did for Facebook and slow down the growth to a certain percentage point and linearly ramp it down. I think what would be also, I'm not sure how helpful this is going to be, but I also pulled up some information about how quickly the overall world's e-commerce sales is supposed to grow by. So I want to calculate the CAGR from, let's see. Well, first off, let me just type out the numbers. Yeah, and I don't know exactly how helpful this is going to be, but we'll see if it provides any value. So 2020, start off with 2020. So 2020 is 4248. It's 4938, 5542, 6151. Obviously, I think Shopify will grow faster than, whoa, what's going on here? So, oops. 7379167676151. Dang it, I have a weird copy row thing going on. 615155424938. Okay, so let's see how quickly this the overall market is supposed to grow. So 2021, okay, wait, sorry. And then let's see what Shopify's growth was. I think what we might be able to do is basically take a multiple of the overall, wait, where's transpose? Okay, so Shopify has been growing. Let's see, 2020. And actually, we need to look further back. So basically what I want to try to do is see what multiple Shopify was growing at versus the world's rate and see if there's like a pattern we can use. I'd be kind of like, it'd be very lucky if there's like a stable pattern we can rely on, but usually it's never that easy. Okay, so 2015 was 1548, then 2016 1845, 2017 2382, 2018 was 2982, 2019 was 3351. So I see there's some questions about the full year 2021. We're not really forecasting it because we're just going to pretty much use what the street is estimating, and they're going to be pretty accurate. So I think what I'll have to do is project 11 years, but really it'll be 10 years in one quarter. All right, so I think this should be interesting. Let's look at the multiple. All right, so the earlier years are not going to be super helpful because Shopify was just growing super quickly and it's a young company. But it looks like 2017, Shopify grew 2.5 times the world's growth. Then 2018, 2.4 times, then 3.8 times, then 3.2 times, 3.5, 2.7, 3.2, and then these numbers are probably not super reliable, but I mean, to me, there is at least some range that I think there is a range here that seems to make sense. So, or there is like a range that exists here, which is around 2.4 to 3.8. And I think that's like a rough way we can figure out how much Shopify's growth might slow down to. So, and that's what I personally would feel comfortable with. 2024, I think, is what we said was unreliable. So we're going to have to kind of use our own metrics. So this we can delete. And 2022 and 2023 are reliable-ish. So grew by 2.7 times. Let's see what the average was over the past few years. And normally it's also important to like audit, you know, the information I got from here. Hopefully this is like, you know, relatively correct. I think the historicals probably are, because it's really just a matter of adding a bunch of sales figures. But it seems like over the past few years, Shopify has been able to basically around 3x the world's growth. And I think that's, given that Shopify besides Amazon is pretty much the, you know, dominant player, I think a 3x multiple is pretty, is not a reach. So this brings us to revenue growth from 2022 of 33%, another 33%, 30, 28. I don't really like how it's not slowing down though. Okay, and this fell by 2.7. I guess it really just depends how conservative you want to be. But okay, so 28, let's just do this. 2025, let's grow it down to 28%. All right, it's a little sloppy, but okay. I mean, these are the numbers, so we'll just use our different cases to have a range. But I think this is actually 56, 33, 33, and the street thinks 35. Okay, so I guess that kind of makes sense. And then 2025 street thinks 28%, 27%, which is like around the same range. So I guess these numbers are within the realm of possibility. I don't think they're too, I think they make rough sense. And so let's have the target here, and then I'm gonna linearly grow it down. Remember how to do this. So previous minus that divided by that minus that. Okay, so this is linearly growing down to 5%. And so that's where you want to ask. So if the world is slowing down to 9% by 2025, it looks like it's decreasing by around 1% a year. So if we projected that out to 2030, that would be -5, so roughly 4%, but Shopify should be a little higher. Also, we talked about projecting this out for an extra year. Oops. All right, and then I need to fix this again. Stay the same, and then this should stay on the same row. All right, so Shopify, if the market follows the same pattern, this is just to get a rough sense, by the way. I know this is like, we don't really know how slow the market's, how much the market's going to slow by. And it could actually, these numbers could actually be pretty conservative, which I assume they probably are, because e-commerce will probably grow exponentially, and humans are not super good at understanding how things grow exponentially. So it seems like the world e-commerce market will drop by probably like something like 0.6% here if we were to follow this trend, 0.5% here, 0.4% here, 3%. Okay, and then if we have a these numbers might be too high. So if we were to follow the exact same approach we did before, then Shopify should slow to 22% growth in 2030. It's not impossible, because like companies like Google are still growing at like 15%, and Shopify is such a huge company. Or sorry, Google is such a huge company and still growing by 15%. So it's not it's not out of reach, but I'd still say that's pretty aggressive. So what I'm going to do here, and just to double check, I want to actually look at Google's growth. All right, so Google is growing at 17%, 16% still. And Microsoft also 15, 14%. So I'd say like 15% for like a very mature company. 10 years down the line, what will Shopify look like? I think 15% is pretty reasonable. Not super aggressive and not super optimistic either. All right, so now we have that case, and I want to make it dynamic, so we're going to connect it to the switch. Oh. Dang it. Okay. Oops. All right, so this basically says that Shopify will grow into a $40 billion revenue company in 11-ish years. Okay, so now we have to think about our conservative case. And for 2021, since again, it's only a 1 quarter that analysts are projecting out, I'm going to just say that this is pretty accurate. It's not going to really change much if we increase or decrease this by a little bit. So I'm just going to keep that the same. And then 2022, let's see how I built this out before. Don't need this. And freeze our panes. And hopefully you guys can still see everything, but I'm gonna need to decrease the size of everything so that oh shoot. Oh man, I hate it when these lines show up. Kind of forgot how to get rid of them too. Oh, that's how you do it. Okay. All right, so 2022 revenue growth, I guess we did build it out a little bit last time. I think conservative case, we can decrease it by 2%. And then, all right, so let's make that 31%. And then in an optimistic case, we can increase it by 2%. Well, actually, the range should be actually bigger. So let's decrease it by 5%. Increase. So the reason I'm doing this, like I want a pretty broad range because then we get a better sense of valuation in terms of like what is the potential outcomes. And the reason I want a pretty wide range is because look at Shopify's growth in the past, right? It's pretty high. And so for going from 56% to 38%, I would say that's maybe the optimistic case versus the street, but I don't think it's wildly optimistic. I'd say it's pretty reasonable as an optimistic case. And then 2023 onwards, this is where we'll probably just have to start linearly. Well, actually 2023 also, we can do a similar thing since we have it already built out. So 28% again, and then 38% here. So let's do this. And then we can have everything linearly decline. So there. Okay, and then, so since we are growing down to 15% in 2031, let's decline down to 5%, which I would say is like pretty aggressively conservative, 10% decrease pretty much. And then for our optimistic case, let's use what we had previously, similar to, So we have 22% here. And I think 20% would be pretty optimistic. Why did this show up again? This will be 20%. Also, I know some of you guys are answering questions while I'm not on the chat. Really appreciate that. It's very, very, very helpful. So whoever's been answering questions for others. Really appreciate it. Okay, so there's like a error thing because the formulas are different, but we're going to ignore this. Okay, so I think I'm fairly comfortable with our range for revenue. We have a much more conservative case, which is helpful because then we can see what the true downside looks like. And then this revenue growth, the middle of the pack, I feel fairly comfortable with that. And then our optimistic case, if you're a true Shopify believer, I think this also makes sense. Next, let's take a look at EBIT. And this is where things are going to get actually pretty tricky based on what we looked at earlier. Because this is GAAP EBIT. And then what the street seems to look at a lot is the non-GAAP EBIT, which is a lot higher and adjusts for a lot of different items. So let's see. Generally, I think it is better because normally if you're modeling this out and you want to do it the way the company looks at EBIT, there are like some adjustments that the companies make in order to sometimes it's just to pump up their own numbers, but other times it's other times there are actual things that you need to add back to your EBIT in order for it to be a true representation of what that company is earning based on its like operations. And I say that this will be a little bit of a bad shortcut, but I think it's better to just use what the street seems to really be focusing on. Oops. These figures are a little weird. Let's see if our historicals have any like helpful information that we can look at though before I just start using it. Okay, so there are adjustments here. Oh, that is very helpful. All right, we're gonna trust Shopify's adjustments and treat these EBIT figures as what is true. But what I don't like is that the margins are declining. It seems a little odd to me unless Shopify is making some pretty aggressive investments in 2022 and 2023, which is possible. So wait, these numbers are okay, these numbers are pretty odd. Not super reliable. Let's see if there's any like good banks that we can see if they're reliable. Oh man, not reliable at all. Okay, well, I think one thing we can do is look at a similar company-ish, Amazon. Operating income. So just for reference, I just want to see what Amazon's operating income is, but their business is so different because they also have the cloud computing aspect actually, so I don't think this is a good idea. Okay, I know. We can look at 2021's adjusted operating income. So here, adjusted EBIT is here, and then revenue up here. All right, so in the past 3 quarters, Shopify has been at 21%, 21%, and 12%. Let's also look at previous quarters. Oops. So on an adjusted EBIT basis over the past, let's say 4, 5, 6 quarters, which is where Shopify has really seen a huge boom and has been able to become more profitable, the average seems to be 18%. So on an adjusted EBIT basis, this is roughly where Shopify is heading, 18%. Okay, so this is helpful. But what I actually don't like right now is, and I don't really know what the greatest solution is, like we need to project out EBIT for 11 years, 10 to 11 years, and it's such a question mark as to what these what this will actually entail, or what is like a reasonable number for it to kind of grow to. So I think, first of all, okay, so I think the 16% is okay because we just saw that the average was 18%. So I think this is like a little bit more conservative, but it's fine to be more conservative in your model. And over the next X number of years, the question is how much to grow it up until. I'm just trying to think about the best way to do this. Because I know there's some equity research reports. Let's see if I have any. All right, I'm gonna go on my other computer and pull some reports. Yeah, I'll give an update to you guys, but I'm gonna email myself some reports and then that I have on this computer here, and then show it to you guys. Okay, so as I pull up the research, someone asked if I could give an update, and I am happy to do so in a minute after I pull these reports up. All right, so these are some equity research reports that I pulled a long time ago, so they're not super relevant probably, but I think it can give us head us towards the right direction. So yeah, this is like a year old, but let's see what they thought, the street thought, if they project out far enough. I think I remember seeing 20%. So operating margins reached an all-time high of 20%. Gross margins, blah, blah, blah. Oh, okay, so interesting. Morgan Stanley says that in their bear case, revenue grows at 20% CAGR to reach 21 billion in 2031. Okay, optimistic case in 2031, 56 billion, while we have $40 billion for the. So I have 40 billion in my base case, and Morgan Stanley had 37 billion. Okay, so I think, cool. My numbers, I think I feel pretty comfortable with for revenue. And then EBIT is the real question mark right now. So management continues to invest at a greater scale. We see operation efficiency. Operating margin reaches 25% in 2031. And then in the bear case, higher gross margin, blah, blah, blah. Nothing about operating margins. In the bull case, gross margin compresses, blah, blah, blah. Okay, well, so we got one really helpful data point here. Operating margin reaches 25% in 2031. I do think that gives us a good sense. So, all right, going back to the model, so far what we've done, just to review for the people who just joined, is we didn't build out everything here yet. So let me delete what we don't have so far. Okay, so what we did so far is we looked at Shopify's income statement and then looked at what the street is estimating. We looked at cost of goods sold. Whoa. We looked at the whole income statement basically. Then we got to some of our cash flow items. And then now we're just at the part where we're projecting out our DCF. We're projecting out our cash flow. And right now what I was kind of stuck on was our EBIT. And so if we look at, so the past 3 quarters, let's see what the average was. It's 18%. So I think it makes sense to make that 18%, right? And so this is gonna have to be a hard code. And by the way, if you guys are wondering how much longer before we get to a price target, I'd say probably 30 minutes. The EBIT is pretty much the hardest. Everything else is gonna be pretty easy. All right, so let's carry on here. So 12%, 13%, seems like what we just will need to do is grow it linearly to something like 25% here. I think that's fair. So again, let's look at other like really mature companies and see what their margins are at, even though they are very different. This is EBITDA, so it should be EBIT. I guess I don't have EBIT margin, but, and this is just some financial data for companies, and something I send out to Patreon members each week and update it with like the latest figures and estimates and stuff. It looks like EBITDA margins for some really mature companies: Apple's 33%, Microsoft 50%, Alphabet 41%, Amazon 15-16%. Okay, this is pretty helpful actually. This is probably like a base case and a conservative case scenario. We should kind of trend towards Amazon since it's an e-commerce player. And all right, I think basically 25% is more on the optimistic side. I'd say 20% more base case. Sorry, I can't talk today. And then 15% is a more conservative case. So I'm pretty okay with that. So here, conservative case, I'm going to make this 15. Street case, 20%. Wait, Morgan Stanley thought it would be 25%. So let's make that pretty big. 25%. And then optimistic case, 30%. And this is where DCFs are just such, like you can see so many projections are being put into here. And so you really have to think a lot about what do you personally believe. And this is also why we're getting a pretty large range, because so many of these assumptions, like there's just no way anyone can predict them to be correct, right? So you just got to do your best and then see what the data tells you. Okay, I think this is all working. All right, so now we have our EBIT. That was the hardest part. Everything else is going to be pretty easy. Okay, I'll try to speed through the rest. Actually, also, I think what will be a good test tomorrow is once Shopify's earnings come out, I want to compare against this A23 number, because this is 2021. There's a quarter left, so we'll see how close that number actually is. All right, so we got our EBIT. Taxes are going to be, also a little bit confusing because Shopify was losing money for so long. They have net operating losses, and so you basically just sum all of those up for a while and you don't need to pay taxes on that amount. And so Shopify's tax rate is going to be kind of tricky as well, because it's going to have to ramp up to a positive tax rate. Oh man, this is going to be tricky too. So yeah, for example, last year in 2020, Shopify, it says here, parentheses, benefit. So they actually had more income and they didn't have to pay taxes because they were unprofitable for so long. And let's look what it's going to look like in the past few quarters. So it looks like they are paying taxes. So let's calculate what those tax rates are. All right, so on average, Shopify paid 9% on taxes, in 2021. There's no, and so it went from 8% to 4% to 14%. Okay, I feel pretty comfortable that if this next upcoming quarter should be positive for Shopify, so I would assume that it would grow a little bit more. So let's call it 0.15. So yeah, roughly 10%. This is not going to affect our model too much, so I'm not going to sweat it a ton. But 10% here I feel like is pretty fair. And then we'll have to grow it to the corporate tax rate, which I believe right now is at 21%. Yeah. So I think in the next, let's call it 4 years or so, I think it'll reach this 21%. I think that's pretty fair if like Shopify maintains being a profitable company. Actually, maybe even faster, 21%. Because they're going to eat up all the net operating losses, because these aren't very big numbers and they're already positive. So I think they'll ramp up pretty quickly. So let's just here, I'm going to take some shortcuts. I'm going to take an average of these two. Okay, and then in a conservative case, we assume that it ramps up even faster. So maybe like this plus 2%, and then 21%. And then in a conservative case, let's say it's slower. All right, and red just means that something weird, like something very like unusual-ish is going on. And so that's why, just to mark it, I'm doing that. All right, and also huge thank you for all of you guys who are staying on and listening. Like, I'm always surprised how much of you guys actually want to watch this stuff. And I'm hoping that it's interesting to some of you guys. Tax rate. Let's see what the tax rate was before in the United States. In 2008. Okay. Corporate tax rate was 21%, 1993 to 2017. Wait, these are taxable income brackets. Basically what I'm trying to look at is if we get a new president and that person is much more aggressive with taxes, corporate taxes, then what will it increase to? Looks like here 35%. So what it used to be, and that's pretty damn high. Tax rate conservative case, make it 35%. And in our street case, we just think everything is just staying the same, so that's 21%. I don't know if it was any time lower. Wish this could go back more. Oh, so it looks like it's only been going down in the US. I don't really think that we can have a more optimistic case than 21%. Maybe that is our optimistic case, and then our street case is, oh man, it's a little messy, but it's in between these two. 28%. That's actually kind of fair. Okay, so what year is this? 2024. Next presidential election. Yeah, 2024. All right. Okay, so we got our taxes now. All right. And there's a lot of activity in the comments, and it seems like this guy or girl, 5 Mile Mac, is pretty. I'm not gonna read everything, but yeah, DCF. I feel like people who hate on this stuff, it's like everyone who does a DCF knows that it's not what you should base everything on. It's just one aspect of investing, right? And if you want to ignore it completely and do something else, like you could use relative valuation, just look at trading comps. You can only focus on the qualitative if you want. But if you're not interested in it, then why are you in this stream? Okay, so this stuff should be pretty easy to project because these numbers are so low. And yeah, honestly, I think I feel very comfortable just taking the average over the past 3 years because these numbers I doubt they're going to really affect much. And I don't think they're going to really change that much. And yeah, you could argue how let's spend more time, perfecting every aspect of the model, but for something like this where you actually are going to be adding DNA and subtracting capex, right? So, and these numbers are going to be very, very close to each other. It's not really going to affect your overall analysis much, but it's still important to have. Okay, then change in net working capital. We're almost done, guys. We have like 15 minutes and we'll get to a price. So let's see. Cash flow, change in working capital. Pretty small numbers, which I love to see because it just means that we're not going to really have to worry too much about the figure. So I should make everything here. Of change in sales. $2013. Where was that? Oh yeah, change in working capital here. Okay, let's also get a percent change in percent of sales. All right, almost done, guys, almost done. Okay, so looks like change in net working capital actually negative in some years, which is possible because it's like Shopify is a subscription-based company, so I'm guessing they have a lot of deferred revenue, which means that they get money first and then they deliver their services. But yeah, I'm not going to look into it too much because it's such a small percentage again that if we take an average over the last 3 years, let's see what brings us, -2%. I'm gonna, this is like so negligible that I think it's actually safer just zeroing things out and not really having it as part of our analysis. So I'm just gonna zero it out, which is, and it's fair, right? Because sometimes positive, sometimes negative. Okay, now we are almost, really almost there. So what's going on here? Oh, we don't need these. Okay, I'm gonna actually move these because I have such little room to work with, kind of bugging me. So I'm gonna move all this here. These panes. All right, we're almost done. We're almost done. Okay. Okay, so we got our earnings before interest after taxes plus our DNA minus our capital expenditures minus our capex. And then we need our discount rate and terminal growth rate assumptions. So let's take a look at what the street is saying. So Morgan Stanley is using an 8% WACC, pretty low. What company is this? Guggenheim. Guggenheim use 9%. So it looks like a range of 8 to 9%. I would say that's kind of optimistic to use an 8% WACC, so I'm going to use that there. 9% for the street case, and then 10% for the optimistic case. Let's see if they have a terminal growth rate. Actually, we don't need a terminal growth rate. It's just normally around 2.5% here. Optimistic case 3%, 2%. These are switches here. Oh, wait, should this be a percentage? Oh yeah, it should. So this should be choose function. This with this. Oh, my posture. All right, so now we're gonna discount everything back to present value. 1 plus our WACC. I'm gonna name this, oh, this is named WACC, this is TGR, so equals that divided by, and by the way, if I as I'm going through anything, if you guys have any questions, I will answer them at the end. I'm just trying to get through everything first. All right, and as we discussed, 2021, there's only a quarter left, so we're only really projecting out 1 quarter. I'm just gonna take a shortcut and take 1 quarter of this, which is not really like the best thing to do, but or like the most accurate thing to do. But I think for our purposes, it's not really gonna change our analysis that much. So I'm just gonna take a quarter. And then this is from the Facebook stuff. Don't need that. Terminal value. Well, we're going to use our perpetuity method. So I'm going to move this over here for now. Almost there. So terminal value is your last projected year's cash flow times 1 plus your terminal growth rate, all divided by your WACC minus your terminal growth rate. Then we have to, sorry, these lines are bugging me. I don't know how to get rid of them forever. Oh well. Then we have to discount this back to present value. 1 plus your last projected year. I'm going to take it from year 10 because taking year 11 will push things out 1 entire full year. Actually, I'll make it 10.25. Wait. 10 point... wait, let me think. Okay, I think I'm actually going to need to make some adjustments here. So, this will actually, the way we're doing it right now will actually discount things too much given that this is taking it out of after 2 years. So I do need to adjust for this. Okay. I haven't done this in a while, so I'm gonna have to kind of think as I do this, but I'm just kind of try to get the proper discount periods. Adjusted period. Actually, it won't be too hard. So we're only taking a quarter of the first year. So then after that, it should just be that. This should be our actual discount period. This is different from mid-year convention. It's not mid-year convention because if we use mid-year convention, it would be so 0.25 in between 0.25 and 1.25 essentially, but we're not going to use mid-year convention. So what we're going to do here is take it to the power of this, then multiply this by 0.25. Oops. Okay, and then our terminal value will be that to 1 plus your WACC to the power of your last projected year. Cool. All right, so then we're almost there. Getting to our enterprise value. Oops. All right, 65 billion. But let's look at what the equity value should be. So I'm just going to take a shortcut and use whatever facts it tells me, but where is your cash and debt figures? Okay, I guess they don't have it, but fully diluted share count 127.6. Normally you also want to properly calculate this out with like stock options and all that, but we're not going to do that. And then let's look at their balance sheet. In the last quarter, their debt was current portion of leases, blah, 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 long-term debt. Do they have any short-term debt? Looks like they don't for some odd reason. So they have 910 million in debt, and then let's look at their balance sheets again. So enterprise value minus debt, oops, plus cash, equity value of 72. Implied share price, this is what we've been working towards, 567.91. I think that actually makes a lot of sense. So DCF implied share price, 567.91. Current price today, current price today, 874.68. All right, so the reason I think that makes sense is because Shopify, everyone already knows, is overvalued from a fundamental DCF perspective. But I wanted to do this anyway because I just was curious, like how overvalued is Shopify? And I feel pretty comfortable with the numbers that I projected here because I walked you guys through everything. So I guess this is where the price discussions happens. And right now, everything is in the base case assumption, right? And I don't want to actually change anything. Like usually after you build out a DCF, you can look at what the implied share price spits out. And right now it's showing that there should be a 35% decline for like a true intrinsic value. But in this case, like I don't actually think that this is super far off from like a fundamental perspective. I do think, let's use what Morgan Stanley uses for its WACC, 8%. Like, sure, I can be a little bit lenient there. Let's say that if we had our more optimistic revenue growth of it going to 20%, like sure, there's a world that could happen. Then Shopify should be at 990. If we believe that in the optimistic case, the margins grow to 30%, within the realm of possibility, but pretty aggressive, then I would say then that gives us implied share price of 1,168. So as you guys can see, basically the more optimistic your assumptions are, the more Shopify quote unquote is worth on a DCF perspective. I think if I had to choose personally from these assumptions what I personally think is going to happen, then let's see. So revenue growth is growing towards 15% in 2030. Like I think it's good to be a little bit more on the conservative side. And so rather than saying like, oh, Shopify will continue growing to 20% in the year 2030. Oh, actually this is 2031. And I walked you guys through, I showed you guys how Google, Microsoft, Amazon, those companies are still growing around 15%. They're much, much larger than Shopify, right? So I think in 10 years or so, Shopify will still probably be smaller than those companies. If Shopify is growing at 15%, I think that's reasonable. And EBIT margin, target rate of 25%, I also think that's pretty reasonable. Taxes, 28%. I think taxes we can be a little bit more on the optimistic side. But again, this doesn't really change our analysis that much. For our WACC, I'd say I'm okay with being a little bit more optimistic here. So base and then terminal growth rate 2.5%, I think that's fine. But essentially, this is a price that I think Shopify should be trading at based on the fundamentals. So $750. That's actually not too bad. So normally for a high growth company, if your DCF is telling you something really low, usually like that's what you expect for a high growth company. In my case, based on what I personally believe, Shopify is actually fairly close to its current price, even while being like relatively a little bit more on the conservative side with my projections. So honestly, I don't think Shopify is at a bad price right now even. I think you do take on a little bit of risk if you do buy at this price. But we'll see how Shopify performs in the next quarter tomorrow. I think personally that if, let's say, Shopify were to decrease to anywhere in the 700s, I think it's something I would for sure buy. At the current price right now, I'd say it's more like a soft buy, just because you're getting there's all the qualitative aspect of Shopify, of the company being like such a major player in e-commerce. And at the beginning of this video, I mentioned to all of you how I ran an e-commerce store on Shopify for 2 years, and it was like, it's something I did full time, and I know how sticky the platform is. And with e-commerce growing we looked at e-commerce market overall market numbers and how quickly that's going to be growing, and Shopify will be at a 2 to 3 times multiple of that growth rate. And yeah, if you guys ever use Shopify, you just know like how sticky the platform is. So to get a piece of that company and hold for what is like a relatively fair price compared to its current price right now, like I think right now like is a decent time to start a position. I wouldn't fault anyone for it. I do think like when Shopify was at 700, 800, 1700, 1500 to 1700, that was just like way too overvalued. So yeah, I think that's like the overall conclusion I would make. If there's any hint of macroeconomic factors not weighing in on the company or not weighing in as much, sorry, I'm really tired. It's like, what time is it? It's like 4 a.m. here in Korea. Then I would think that the company is probably going to just shoot up even more because companies will be more forgiving and on its, man, I can't talk. If macroeconomic factors get better, inflation starts declining, and the interest rates that are going, the interest rate hikes start not to be so much of an overhang on the markets, and growth kind of can like take a breather and kind of get back to the valuations it previously was, then I can totally see Shopify going back to 1,000. It's basically what I'm trying to say. All right, so now I mentioned that I would leave some question or time for sorry, I can't talk. I said I would leave some time for questions, and so if you guys have any, let me know in the chat. And are you gonna buy Shopify at the price right now? I actually have Shopify. Before I did this analysis, I bought it at around 1,200, which I didn't really look into the intrinsic value at all. That's why I wanted to look at Shopify's price, and I only bought one share, so it wasn't much. I do really want to buy one right now, or I do want to really buy Shopify more right now to bring down my cost basis. I might buy, but I'm sorry, I can't really give you a really great answer. I would have to sell something in order to free up some cash and then buy, so that's why. But I think it's like 75% likely that I would buy at this price, basically. And if it were to dip more, let's say market crashes and Shopify goes down to like 500, I would for sure buy at like 500, 600, probably 700. I think those are really good prices to buy Shopify at. And if Shopify has really good earnings tomorrow, then their stock price, I'm sure, will shoot up. Can you do this stuff for crypto? So I did attempt to do it for Bitcoin. Not really like with all these financial figures, but some way of modeling it, but ended up being like a very poor analysis because I was just looking at historical figures. And I think a better way to do that stream again, like I would probably look at all the investment fund, like institutional investments or money markets in the world, and like see what percent is in Bitcoin and what we need to believe actually for those institutions to enter in and purchase Bitcoin for Bitcoin's price to go up. But all right, I don't think I can really find that data. EBIT you're using is analogous to NOPAT, net operating profit after tax. Yes. Is the data you get for the scenarios available for free? All the data I actually pay for, Visible Alpha and FactSet. Visible Alpha is like $700 a month and FactSet's like $12.50 a month or something. So it's kind of expensive. Appreciate shortcut video on Excel shortcuts. I will maybe try to do that in the future. Is Boston College solid for IB? I would say it's on the fringe of being on a target school. I don't think it's a target school per se, but there are people from Boston College who do get into banking. NVIDIA, I'm not really sure. Is there any way to do a DCF for unprofitable businesses that do not disclose long-term profit margin targets? Yes, you just will have to compare against other companies that have similar business models and do have targets that you can use. That's like the best you can do, and it can give you a rough sense. But any DCF valuation is just like you have a range for a reason, and that's because these assumptions, there's so many that go into it that whatever you project is going to be wrong. So it's just a matter of like feeling relatively comfortable, I guess. All right. Should you start with learning accounting for this first? Yes, accounting is definitely the fundamentals for all of this. So Barry, out of curiosity, if you like Shopify for your business, why did you choose Patreon over it? Shopify better. So Patreon is Shopify. You can't really. They serve like very different. I don't know what you call it. They're very different businesses. Shopify's are e-commerce and selling, and Patreon's more for like content creators. So Philip says, I know the focus of your videos, DCF valuations. Do you have time for relative valuations? Yeah, I do that at the start of each month. Or I did in the past like 4 months, except for last month, I think. But I will do it at the start of each month again. Could I do an LBO model? Yes, I'll try to do that in the future, I guess, but I'm a little rusty, so I'm going to even have to practice to do that. Cool. All right, so I think that's pretty much it. And for all of you guys who stayed on for the entire stream, props to you guys. And thank you for staying on, I guess. Hope this was interesting / helpful. And I'll catch you guys on the next stream. Bye, everyone.